Welcome to the Deep Dive, where we unpack the latest earnings calls to give you the crucial insights without, all the information overload.
Exactly.
Today, we're cutting through the noise of JPMorgan Chase Co's Q2 FY25 results. They are, of course, the world's largest universal bank.
Huge institution.
Right. Our mission here is simple. Zoom in on what truly moved the needle for JPM, what their leadership is signaling about the broader economy and where they're headed strategically.
It really was a fascinating call. You get this picture of a bank operating at just immense scale, but also, really engaged in shaping its future.
Yeah.
We saw some undeniably strong numbers, but also some, honestly, incredibly candid commentary on regulation, capital, stuff that really gets their long-term thinking.
That's the thing with these calls, isn't it? It's not just looking back, it's a peek forward. So let's start with the headlines, the results snapshot.
Okay.
You heard it right. JPM delivered a solid beat pretty much across the board. Revenue hit a massive $45.68 billion, easily beating the $44.06 billion consensus comfortably. And EPS, earnings per share, came in strong at $5.24. Again, well above the $4.48 Smith.
Big beats there.
And net interest income, NII, basically the profit from lending versus paying depositors, that climbed 2% to $23.3 billion.
Right. And credit loss provisions actually eased a bit, down to $2.9 billion. That gave profitability a nice boost.
By any measure, those are robust figures. Really strong.
Absolutely. And what's particularly interesting about that NII climb to $23.3 billion and the lower provisions, it really signals how well they're navigating the current rate environment. They're clearly optimizing the balance sheet effectively. That's a real differentiator when, some other banks are seeing NII actually shrink.
Good point. But despite these strong headlines, the stock reaction was, a bit muted. A slight dip, 0.7% the day after the call.
Yeah, on pretty decent volume too, about 1.4 times average.
So that muted reaction, that little dip, it feels like more than just profit taking, right? It feels like a signal.
I think so.
Like investors are looking past the headline beat and asking, okay, but what's the sustainable growth from here? Especially with the macro warnings Jamie Dimon keeps giving.
Exactly. That selective sentiment is key. It's like the market saying, great quarter, guys, but what's next in this tricky world? Show me more kind of attitude.
Right. Or maybe just acknowledging that even a giant like JPM has to deal with those bigger economic worries.
Precisely. So to really get where that strength is coming from, let's peel back the layers a bit. Look at the underlying financial health.
Okay, let's do the deep dive.
So the firm reported net income of $15 billion and a really robust 21% return on common equity, ROCE. That's a key profitability metric.
Very strong ROCE.
Yeah. Expenses were $23.88 billion, mostly driven by comp, brokerage, and interestingly, auto lease depreciation. And something else, higher risk-weighted assets, RWA, basically weighting assets by risk. That actually contributed to a 40 basis point dip in their core capital ratio, the CET1 ratio, bringing it to 15%.
So holding a bit more capital against potentially riskier stuff makes sense.
Seems prudent.
Okay, that focus on capital sounds crucial. So what's the plan then for capital allocation, for shareholder returns?
Well, first off, the board intends to hike the dividend to $1.50 per share in Q3.
Okay, nice bump.
Yeah. And management talked a lot about their capital hierarchy. The priority is deploying capital for growth, both organic and potentially inorganic, and making sure that dividend is sustainable.
But
big deals, major acquisitions, they said those face a really high bar right now.
Right.
And they explicitly noted that buying back stock when it's trading near 3 times tangible book value, less appealing.
So expensive for buybacks.
Exactly. What really stood out was the clear message. The best use of capital right now is organic growth, growing from within their existing businesses.
That's interesting, prioritizing internal growth. But you wonder, for a bank JPM size, how much organic growth is really left? Or are they just not seeing good deals out there?
That's a fair question. I think it's probably less about running out of room and more about just being super disciplined. They have incredible scale, obviously, but they still see ways to go deeper with current customers, expand into niches organically. It feels like they're not looking to buy growth, but cultivate it.
Which suggests confidence in the core business.
Exactly. Often a good sign.
Okay, so with that bigger picture, let's drill down into the segments because that's where you see the different parts of the machine working. Let's start with Consumer and Community Banking, CCB.
Right. CCB posted a healthy 6% year-over-year revenue increase, particular strength in wealth management, and card services and auto revenue, up 15%. That was fueled by higher revolving balances, people carrying more debt on cards, and just strong new account growth. Card loans outstanding were up 9%.
So the consumer side still looks pretty robust, benefiting JPM.
Yeah, capitalizing on that spending.
Yep.
Now, shifting over to the institutional side, the Commercial Investment Bank, CIB.
Okay.
Revenue there grew 9% year over year. Investment banking fees were up 7%, and importantly, they kept that #1 wallet share.
Impressive. Shows those deep relationships.
Totally. Advisory fees up 8%, helped by more sponsor activity, private equity deals.
Sure.
Debt underwriting up 12% thanks to some large deals.
In markets?
Markets revenue surged 15%.
Right.
Really strong performance in currencies, emerging markets, rates, commodities, though they did mention some softer spots, like in securitized products and fixed income financing.
Okay.
And notably, commercial loan growth was strong in the quarter. Driven by new lending to bigger companies and more deal activity towards the end of the period, it just shows the sheer breadth of their reach.
Right. Okay, and the third leg of the stool, asset and wealth management, AWM.
Yeah, another powerhouse.
Yeah.
AWM reported a 10% revenue increase, helped by strong net inflows, money coming in, and just higher average market levels.
Makes sense.
Assets under management, AUM, grew a really impressive 18% year over year. That's up to $4.3 trillion.
Wow.
Yeah. And total client assets hit $6.4 trillion, up 19%. Just a powerful quarter for AWM. Shows clients are sticking with them.
Okay, so strong performance across the board, really. Now let's zoom out again. Broader implications, management outlook, key themes. This is where you get beyond just the numbers.
Right. And CEO Jamie Dimon, he characterized the U.S. economy as resilient, pointed to healthy consumer spending. But in classic Dimon style, also emphasized they're preparing for geopolitical risks, inflation risks.
Usual caution. Things are okay, but...
Exactly. Don't get complacent. That's the vibe. On guidance, they lifted the full-year net interest income forecast slightly to approximately $95.5 billion.
Okay.
And the card net charge-off rate guidance, that remained unchanged at around 3.6%. So no major change expected there.
Interesting. So given that caution and the market's reaction we talked about, the whole regulation topic becomes even more important, right?
Hugely important. And is a major focus on the call. Management basically wants regulators to take a step back, review the whole framework holistically.
Which parts specifically?
They call that several big ones. The supplemental leverage ratio, SLR.
Which limits overall leverage.
Right. Then the GSIB surcharge, that extra capital buffer for the biggest banks like JPM, CCR, the annual stress tests, and Basel III, the international rules.
So basically the whole post-crisis regulatory structure.
Pretty much. Their argument is these aren't just acronyms. They really impact how much banks can lend and operate. They think the system could be simpler, cheaper, more effective, and actually safer.
Safer and simpler? How?
Well, they argue things like the GSIB surcharge actually create disincentives for U.S. banks to compete globally, and it kind of inhibits lending.
Interesting argument.
Yeah. They also pushed for a more active securitization market. Packaging loans and selling them on and streamlining mortgage rules. They feel these changes wouldn't add risk, but would really help the economy get moving.
So it's a clear, consistent message. The current rules, maybe taken together, have some unintended consequences.
Definitely. It sounds like they're saying, look, we can be safe and efficient if you just tweak things a bit.
Okay. Shifting gears slightly to innovation and competition. What's the thinking there?
Well, JPM is actively looking at things like stablecoins, deposit tokens. They acknowledge the whole fintech landscape, the need for payments to work together, interoperability.
Right.
On open banking sharing customer data, they support it, but with conditions. Clear terms, time limits, and crucially, a liability shift. So if a third party misuses data and causes fraud, the bank isn't on the hook.
That seems reasonable.
Yeah. And interestingly, on AI, they said they see no strategic need to actually acquire a big, large language model company.
Oh.
They prefer to just use the models, leverage their own data for their customers, rather than owning the core tech itself. It's about integration, not just acquisition.
Makes sense. Focus on applying it. What about credit quality? Any signs of stress?
Generally, no. The consumer picture still looks broadly healthy, largely tied to that strong job market we keep seeing.
Okay.
There was a small uptick in non-accruals, loans not getting paid, but they said that was mainly technical stuff linked to wildfire forbearance out in the LA area. Very small expected losses.
Got it. And commercial credit?
Also described as generally fine, though they are keeping a close eye on the potential impact of tariffs on different sectors. But overall, pretty solid credit performance, testament to the economy, and probably their underwriting too.
Right. And one last specific thing, the Sapphire card changes. they address that?
Yeah, briefly. Positioned it as just a normal product refresh designed to boost the value for customers, especially on things like travel benefits where competition is fierce. They seem pretty confident about the Lounge Access Edition being a big draw.
Okay, standard refresh then. So pulling it all together, what's the main takeaway here?
It's definitely a nuanced picture. On one hand, you've got JPM delivering genuinely strong financial results, beating estimates, firing on our cylinders, as they said.
Operationally very strong.
But on the other hand, you have that slight market dip, that selective investor mood, probably influenced by Dimon's ongoing cautionary notes about the macro world, geopolitical risks.
Yeah, it really makes you think about how a bank this huge navigates that tension. Strong performance meets this heightened uncertainty. It's a real balancing act.
It absolutely is. And those discussions we had about capital allocation and especially regulatory reform, they're crucial. You heard that strong emphasis on organic growth over big M&A, and that very clear call for regulatory changes they think would make the whole system safer and more efficient.
Potentially unlocking more lending, more market making.
Exactly. That advocacy could genuinely reshape the competitive landscape for all banks down the road.
So bringing all those threads together, the strong numbers, the caution, Dimon's strong views on a regulation, and that peak private credit comment he made, it definitely sparks some thinking about how investors might play this.
It certainly does. Which leads us nicely into our This Is Not Financial Advice segment, where we float a trade idea. Maybe something you'd hear debated in a hedge fund investment committee. Given everything we've discussed, here's a thesis. We're calling it the regulatory tailwind peak private credit trade.
Okay, intriguing name. Lay out the setup.
The setup is really Dimon's direct comments, that peak private credit line, plus his constant forceful push for simplifying regulations.
Right, citing GSIB, LCR, the liquidity coverage ratio.
Exactly, and the problems in the securitization market. His argument is clear. These rules hold back traditional bank lending, make it more expensive, and push business into the, less transparent private markets.
Okay, so that's the problem statement, basically. What's the pitch?
The pitch is go long traditional, well-capitalized banks, JPM being a prime example, and simultaneously short, or at least steer clear of, the private credit space.
Long banks, short private credit. What's the rationale there?
The rationale hinges on regulatory reform actually happening, even if it's just incremental progress towards that simpler, cheaper, more effective, more transparent, and safer system Dimon wants.
If that happens.
If that happens, it could totally rebalance the competition. Think about it. Lower compliance costs for banks, more flexibility on their balance sheets, a healthier securitization market, all that makes traditional bank lending and market making way more attractive again.
Okay, I see the logic. Banks get unleashed a bit.
Exactly. And giants like JPM could potentially claw back market share from private credit. Private credit might then face headwinds if its main advantage is flexibility. Less red tape start to fade.
And that peak private credit comment suggests maybe the tide is already turning, or could turn.
Precisely. It suggests the cost-benefit equation for borrowers might shift back towards public markets and banks, especially if the regulatory burden on banks eases up. So this trade idea is essentially a bet on policy shifts making traditional banking relatively more profitable, letting their scale really work for them again.
It's definitely a bold call, relies heavily on that regulatory change actually materializing.
Absolutely. High conviction, but definitely depends on policy shifts.
Okay, so wrapping this up, what does this all mean for you, the listener? JPMorgan Chase delivered a quarter of, frankly, strong numbers, showcased real operational strength across all its businesses.
Yeah, impressive execution.
But the strategic story goes way beyond just Q2 earnings. It's deeply tied into the macro environment and this ongoing, very public debate about financial regulation.
It really is a case study in navigating a complex world with both strong performance and strategic foresight.
Absolutely. Now remember, as always, this deep dive is purely for informational purposes. It is definitely not financial advice. Markets are complex, investing carries risk.
Please be mindful of that.
But we'd genuinely love to know what stood out to you from our discussion today. Was there a specific comment, maybe on regulation or capital, that sparked some ideas for your own thinking? Let us know.